All right, this is being recorded. One thing I say at the beginning of all of these is watch this again shortly after going through this webinar, you guys. I mean, last week we had somebody get a little frustrated, and I think they left a little early, but at the end of the day, I know this stuff is going to fly at you pretty fast. You know, I mean, one thing you can do is go online and learn how to do a long put diagonal, and it's easy to read how to do a long put diagonal, but it's not that easy to learn how to do it the right way. You know, they're going to just tell you to buy and further expiration, put that's in the money, and then sell they might even not tell you to do it in the money. As a matter of fact, they just say buy a further expiration put and then sell a near-term expiration put. But what I'm going to do is I'm going to teach you guys different ways that set this strategy up so that you guys increase your probabilities of success. And that's one thing I teach in all of my webinars. Every strategy I'm talking about is ways to turn the probabilities, or at least try to turn those probabilities into your favor. We're not going to necessarily be decreasing risk or anything along those lines, but I'm going to try and teach you how you can make the probabilities more so in your favor. So I'm going to be talking about a lot of things that you're not going to be able to find online and read about, because they're things that floor traders would look at in order to, decrease our risk in a sense. So, and those guys really aren't telling anybody else online what to do. They're just not going to do that. I'll tell you that. So watch it again, because you're going to be thinking of questions, and I'm going to be talking about different math and how to figure out different rules and stuff like that. It might be like a blur, and some of you guys are going to have blank faces, like washed out faces. Watch it again. I can assure you the second time through, you're going to be kind of like, okay, kind of slows things down, and you'll be able to remember it for much longer as well. If you wait a couple months down the road, you're going to get that blur again where you're trying to relearn it all. So watch it again relatively soon after. But let me get through a couple of things real quick before we get moving. I got to go over a couple of things. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal. For my commentary on everything from economic to geopolitical and market analysis, I've been trading my own money for over 20 years, almost 25 now. One more year, I'll probably be at 25. But I actually moved to Chicago after starting to trade in college. Went to college for a psychology degree, started trading with some money I'd earned, worked on a couple of farms, my family's farm, or my grandparents' farm, and saved up a bunch of money, moved to college, opened up a trading account, started trading, switched it over to finance, and then after graduating college, just drove straight up to Chicago, walked on the floor without any job, and got a job as a runner. And then I moved into the pits and sold all my holdings in my brokerage account and started trading on the floor. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, basically in all market conditions. So I've been there and been through a lot. So I can tell you a lot of great stories too. Trevor, good to have you. Glad to see you're back. I got to go over this too. Any opinions, news, research, and analysis or other information contained here by ProTrader Strategies or associate companies is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. The reason why is because I don't know what's in your portfolios, you guys, and I don't know what your risk tolerance is. And for all of those reasons, I couldn't possibly go out there and say, you need to go out and do this put diagonal in IBM because IBM's ready to sell off and da-da-da-da-da and all these other things. That's not what we're here to do. We're here to teach you guys how to swim. We're not here to swim for you. And if you're paying for services that just give you trades and stuff like that, then you really should be thinking twice about it, because I don't know that you're really learning anything. And one of the things that I champion is constantly learning. So do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Yes, I do talk about my trades in the daily market commentaries, but that is, again, up to you guys to implement that in your portfolio in your own way, or, you know, it's on you guys. I mean, if you guys want to do what I'm doing. So you guys can follow me on Twitter at Wolfman's blog. You know, if you guys, I know a lot of you guys, we were chatting beforehand about Twitter. I tweet out my trades that I'm doing on during earnings season. Most of the trades I talk about in those daily market commentaries, when I get in them, when I get out of them. Don't really talk about that on Twitter, but because those earnings trades I put on in the late afternoon, it's usually after that market commentary, I want to give you guys the opportunity to get in or see what I'm doing, just for full disclosure. Anyway, and you can follow us at ProTraderStrat for some trading wisdom and deals and stuff like that. So check us out on Twitter. Wolfman might have missed last week, could not get in. Oh yeah, so we've been filling up like right away. And as a matter of fact, we're like just a couple of people away from filling in right now. What is it? Runner, is that a code for coffee or for the trade? That is really for coffee. Coffee, gum, whatever it takes. You're the whipping post. Basically what it is you ever see those guys like on TV where there's kids running around outside the pit handing paper up into the pits. That's what a runner is. And that's basically your entry level position, as entry level as you can get. And then usually what people do is they move up into the pits and they face out, and those are the ARB clerks that do the hand signals, and then you turn face in and you're either a broker or basically a trader. I went the route of broker into the pit, so I actually know how to ARB, whereas most floor traders don't even know how to ARB. It's actually quite funny to watch them painfully try to do it. So do you have something in common with Trump tweeting? I do tweet, but I don't know if I have a whole lot in common with Trump. All right, so long put diagonal. You know, in this, you guys might notice I don't do a webinar on the short put diagonal, and the reason why is because I really don't agree with the short put diagonal, and some of the various reasons are I don't like to be short options that far in duration, and I'll show you why throughout this webinar. But this is going to be on the long put diagonal, and if you guys watch a lot of these webinars, you also know that I don't love doing long strategies for that matter, but this one is good in that whenever you're long an option and if volatility expands, then you benefit from that. So we're going to be trying to create this strategy in an environment where we expect volatility to expand, and I'll show you when and where that generally will be the case. So we'll move along with that. So the market assumption is neutral to bearish. Now the reason why this is a bearish market assumption, and you'll read online, it is a bearish market assumption. All right, well, yes and no. The reason why it's more neutral, the reason why there is, I put neutral in there, is because you want the market to be relatively neutral in the beginning of this strategy. We don't want a major market move in our direction right off the bat, believe it or not. The reason why is the volatility and gamma will affect that front month a little bit more in those type of situations. So we kind of want this to really just be a slow trickle down, like a slow bleeding death, if you will, so that our short options decay worthless, and then the market moves towards our long, moves our long put deeper in the money, so that we can benefit from that. But we don't want our short put to go into the money really quickly. We'd much rather have that decay worthless or very close to worthless. All right, so what we're going to do is we're going to be buying an in-the-money put in the further expiration. So with the diagonal, it's not a calendar. A calendar is even further out in time for an expiration. This is going to be literally the next expiration cycle. So right now, front month is basically September. We're going to be looking at October. So they're really back-to-back in sequence of expirations. This isn't taking into account weeklies. We're just speaking strictly of the monthlies. Yes, you can do this strategy in the weeklies, but you really need to make sure there's a lot of participation in those weeklies in order to do that. And I'll explain why here in a little bit. But we're going to be buying the further expiration. So in this particular exam, or in this particular time frame, we're going to be using the October. And we're going to be selling an out-of-the-money put in the nearer one, which is September. Now, usually the best time to set this up is when there's about 35 days to expiration in this front month. There are ways to do it when there's more or less time, I should say, in that, which is what we're in that type of environment. But it makes it a little bit more difficult. You're going to be a little bit tighter with this put. So best case scenario is when you're right around 35 to 45 days setting this up. And then this expiration, we really would like to see a binary event. And a binary event can be anything from, like in Fed Fund futures, a binary event was the FOMC meeting. So that's a binary event for treasuries. A binary event for stocks can be anything from like an earnings call or an earnings release. Or biotech could be a trial release where they come out with a trial results, I should say. Those have a tendency to have spikes in volatility. So we want to take advantage of spikes in volatility in and around some kind of binary event out in the future. Now, you don't always know when those binary events are, but for earnings, they've already told us when earnings are going to be. So we can expect to be able to take advantage of expansion in volatility around this event. So after or before the binary event, we want to set this up where we know there's a binary event in the further expiration month. So since we're coming out of earnings, this is usually when I really like to set up these diagonals. I get ahead of the game, you know, get in there before everybody else is playing. So right now is a good time coming right out of earnings, because as you'll notice, there's not a lot of implied volatility in any of these underlyings. So that's when you take advantage of, okay, I know there's going to be expansion and volatility coming up in October for XYZ because they have an earnings event. I'm going to take advantage of that. So it'll help you out. All right, so the essentials to success. One of the first things is picking the right underlying. And basically what we're looking for is a tight bid ask. The right underlying, you know, Aon, I talk about a lot. I watch Aon. Kroger is another one. Everybody's heard of those different companies, but they don't have a lot of participation in the options for some reason or another. And then there's other ones like Honeywell and I don't know, I can't think of any other ones right offhand, where Monsanto, where people may not necessarily have heard of those particular companies, but there's a lot of participation in those a lot of times. So those are different nuances you need to look at, and picking the right underlying. The easiest way to do this when we're looking at the option montage, make sure that bid ask in the option montage, which is just basically shows the option montage is the area where it shows all of the strikes for that particular underlying. Make sure that bid ask on either the calls or the puts that are closest to at the money are about 10 cents wide on a stock that's under $100. Right? I'll say that again. Picking the right underlying for a stock that's under $100, the bid ask on the closest to expiration month should have tight markets, and those tight markets should be no more than 10 cents wide from the bid to the ask on any one of those strikes that are closest to at the money. Now, having said that, you know, a stock that's over $100, let's say it's like a $400 stock or a $500 stock, just move the decimal 3 ticks to the left, and that's how wide those bid asks should be. So like a $500 stock, move it 3 ticks to the left, that's 50 cents. On a $1,000 stock, move it 3 ticks to the left, that's $1 wide. So that's where we should see those markets on those options. Right? Picking the right strikes. Now this is seriously important with the put diagonal, and I'm going to show you guys an example of how you can set this strategy up wrong when we get the option montage up. You know, I talk about this all the time. You can go online. I know everybody can look up right now. Go online and find Google and look up the put diagonal. You guys can find out how to put this strategy together. But they aren't going to tell you how to pick the right strikes. This is key to the success of this strategy. All right. So, and setting it up correctly has to do with what we're looking to do is pay for the extrinsic value of those options. Now, options that are out of the money are all extrinsic value. There's no intrinsic value. Intrinsic value tells you what that option is worth. So if the stock is trading, you know, 100 and the 95, or let's do an in the money one, the 105 puts are going to be trading about, let's say, $6. Well, those 105 puts are really only worth $5, right? Because it's 100 where the underlying is trading to the 105 strike is $5 difference. So there's intrinsic value of $5. Now the extrinsic value is $1. It's the excess over and above what that option is worth. And that's pretty important, especially with this strategy. Intrinsic value is what that option is worth. So if the stock is trading 100 and we're looking at the 105 puts, those 105 puts are only worth $5. So anything excess over $5 is extrinsic value. Okay, and we're looking to pay for that extrinsic value by selling that put, which is really important. Then we don't have to worry about time decay if we do that. So that's what we're trying to do. And deeper in the money options have less extrinsic value. So there's a little bit of a payoff there. You know, if we're going deeper in the money, it means that the puts that we're selling to finance that can go further out of the money, get further away, making our spread a little wider. Can this be done on SPX or the RUT? Absolutely it can. You know, I like to do it around stocks right after earnings, but it absolutely can. In that case, you definitely want to make sure that you're going to be more directionally biased, and you are going to want to make sure you pay for that extrinsic value so it doesn't hurt you. Because if you don't pay for all that extrinsic value, or you only pay for maybe, say, half of that extrinsic value, for one, you're going to have theta decay in that long put that you own. So make sure you can do that. But if you see something down the road where you're thinking, well, you know, the volatility is really low, so I expect at this point in time, and I expect volatility to expand in the future, then that absolutely is a good time to set something like this up. You don't want to be setting this strategy up with high implied volatility around in the underlying. So, and I'll talk about that here in a minute, but we want to set this up in low implied volatility. But I've gotten a little ahead of myself on those. So picking the right duration. So this is what I was mentioning in the beginning. You know, right now we're kind of in this declining, massive declining theta decay of the option. That's what basically this chart shows. Further out in duration, you don't get theta decay really happening, but inside of 35 days, you get a 50% drop in theta decay in these last 35 days. Now, we don't want to stay in this strategy all the way to the end. For one, remember, we're going to have a binary event in there, and I want to be out of this strategy before that binary event. Remember, I said I want to set this up so our long put is in that binary event, but we don't want to go all the way through that binary event because volatility is going to come out drastically. And when volatility comes out of those premiums, that hurts the person who is holding or is long those options. So get out before that. All right, even if you're right, you know, the only way that I would probably stay in through that binary event is if I was looking at this long put as if it were a full-blown loser. Like I had lost, you know, the market just rallied straight up and those puts are looking like they're going to expire worthless. I was directionally wrong. That's the only time I'm going to leave those on, is when those puts are basically worthless, because then I've already taken my risk. But if you've been directionally right, you're up money in this strategy, take that money off the table before that event, because for one, volatility is going to come out, and two, you could still end up being directionally wrong. So want to get out of this, hopefully for a profit before that binary event. If it's a full loser, then I'm going to ride it out into the sunset. All right, but so we're going to be long the puts out here and short the puts here. So as you can see, those short puts, they're going to decay faster than these long puts. So think about that. We paid for the extrinsic value of these puts, so you're not really going to see this decay happening. But those front puts, we want to see that front put expire worthless and take advantage of this here. So we want those to decay faster than these will. And by paying off that extrinsic value, you'll see that happen. All right, picking the right environment. This is what I was mentioning a little bit earlier and got a little ahead of myself. We want low volatility, and we also don't want volatility to differ more than 2 or 3 percentage points between the 2 months. When we pull up this option montage, it'll become a little bit more clear what I'm talking about with that difference. But we want those to be relatively tight, because if there's a major difference, usually those further duration contracts will have higher implied volatility. And if there's like 5, 6, 10 percentage differences, what that means is you're paying a lot of money for that volatility. You're paying more for those premiums than what you're able to sell premium for. So we want that relationship to be quite tight. And, you know, best case scenario would be that the month that you're selling here in the near term has higher implied volatility than that month that you're buying paying for that premium. So you're paying less for volatility than what you're able to sell. It's a rare occurrence, but you will see that happen. And if you do see that happen, that's the time really to pull the trigger on it, because, you know, they're paying you more in the front month than you're having to pay in that back month. And that is a great situation to be in. But we want it to be close, 2 to 3 percentage points away, and low implied volatility to start, which means somewhere less than 50 IV% for a stock, and something, you know, in below 20s really for an ETF. A couple of questions popping up. When would you use the diagonal instead of a calendar? Basically, when I know that it's really difficult with the calendar to know that there's going to be expansion and volatility that far down the road, and on even more so is it difficult to pay for that extrinsic value. So the situations are a little bit different, but with this, if I can nail a binary event down, then that's when I'm looking to do it. That makes sense. Yes, it can be done. And how would you avoid having the underlying put to you on the short side? Great question. You can't avoid it all the way. But the thing is a lot of people, I can't tell you the last time I've gotten a stock put to me this far out ahead of time. And if it was, then at that point, it's kind of like I've already gotten my trade on. You can take it off, but it's really going to act relatively the same way. And the risk is maybe a little bit more at that point. But at the end of the day, you know, if it did get put to you, you could always buy an out-of-the-money call or something like that to kind of limit your risk again, because the stock is going to be actually you'd want to sell the out-of-the-money call just to kind of limit that risk. But at the end of the day, it's not going to unless you get really close to expiration. It just is such a rare occurrence to have that stock put to you. All right. All right. Okay, I think I got everybody. All right. So, and then knowing our exit strategy before entering the trade. To start, setting this strategy up, we don't want to pay more than 75% the width of the strikes, okay? There's some occasions where you can set this up, and this was one of the things I was mentioning, where you can pay 100% the width of the strikes. So that being said, you know, if we have a $10 wide spread being long, let's say, you know, if the stock's trading the underlying $100, XYZ is trading $100, we're buying the 105 puts and selling the 95 puts to finance that extrinsic value, just to make math easy. Some situations you might find where you're paying $10.01, which means you can't possibly make money on this trade, right? Because I'm paying more than the width of the strike. So the idea here is if it's $10 wide, we're going to be paying about $7.50, which makes our max profit $2.50, all right? So don't pay more than 75% the width of the strikes. If you can pay less than 75% the width of the strikes, then you're increasing your probabilities even more so, all right? So, and then when basically our exit strategy is also going to be at 50% of max profit, all right? I mentioned this, $10 wide, no more than $7.50 as a debit. That's our max loss, right? That's $7.50. So our max profit is $2.50. It's the remaining difference of that width of the spread. Okay, hope I didn't lose anybody yet, right? If it's $10 wide, we pay $7.50, then the most we can make at this point, before that front month expires, of course, is $2.50, right? So we're going to be looking to exit this strategy when we've made 50% of that max profit, which is 50% of that $2.50. That being $1.25, all right? So how do we know when we've reached that? Well, if we paid $7.50, our max profit is $2.50. We want 50% of that, $1.25. Well, that $1.25 needs to be added back into what we originally paid, okay? So when this strategy is trading around $8.75, remember it's the $7.50 we originally paid, plus our max profit target of $1.25, that's $8.75. That's when we're looking to exit, okay? And don't get greedy, you guys. I mean, stick to these rules. You know, I know a couple of you guys, quite a few of you guys actually, watch the daily market commentaries. And, you know, I had a trade where I was like a penny away from 50% of my max profit, and I got a little stubborn. I wanted the penny and not the trade, and it was Philip Morris, I believe. And Philip Morris the next day shot up like $3, right? And I was like, I was kicking myself because I was like, you know, I wanted the penny and not the trade, and it was 1 penny away from 50% of my max profit, and I didn't take it. Well, I did get lucky a couple of days later. The market came right back down, and I was able to get out 50% of my max profit, but I stuck a sticky note right on my desk here, and I still have it. Sorry, my dog thinks somebody's knocking at the door when I tapped on my sticky note. that, you know, stick to the rules. You know, that's what we have to do, because that's how we increase the probabilities in our favor. Probabilities are the probabilities, but you can kind of sway them a little bit if you're willing to take, get out early, okay? All right. I think I got everybody. All right, so stick to that. Know your exit strategy, write it down even. You know, I write it down too, and for one, that makes it easier for you to remember where the 50% of max profit is. Two, if you write it down, you are more likely to stick to it than if you just have it in your head, because your head will play tricks on you. Your head will be like, oh yeah, this is going my way. Nothing can go wrong now. I'm going to get another, you know, 25 cents out of this thing before I cover it. Well, that's when it goes wrong, just like I did. You know, I was squeezing it for a penny, and it went literally way against me. But again, it did come back. But you know, I had to go a couple more days with that trade, and I could have taken that money and allocated it somewhere else, right? I mean, I could have taken that margin and used it somewhere else. So just keep that in mind. Stick to it, write it down, and don't mess around. All right, so we've kind of gone over this once already with our max profit. Our max profit is the width of the strikes minus the debit paid. So we were talking about it, $10 wide, debit paid is $7.50. Our max profit is $2.50. But max profit can be considered not really unlimited, but as long as the underlying goes to zero, that could be our max profit, right? If our front month has expired worthless. So it is difficult to determine that, and volatility will affect that. Remember I said, you know, our max profit could be skewed if we get a major move right away, because volatility will likely affect those short puts more than the long puts, and that can skew what our max profit is. The only real way to kind of baseline it is at inception, okay? But the one thing you do know is that your max loss is always your debit paid. That's not really going to change. So that's the beauty in a long option strategy, is that is your max loss, is whatever you paid is your max loss. All right. Phil, sorry, why don't you just place an FTC order at 50%? You mean GTC? I think you have FTC, a GTC. Aaron, I do actually do that a lot, especially on my naked strategies. Oh yeah, you corrected yourself already. Yeah, so GTCs. I do set up a lot of GTCs in there, especially on naked strategies. And I talk about those in the daily market commentaries. I'm like, hey, I'm putting this in as, especially when it gets close. I don't always do it right away, but when I see it's about a nickel or a dime away or something like that, that's when I do it. I don't like to have a lot of trades in my order book. I don't know why, but it's just me, maybe. But I don't like to have to scroll through a lot of those. So in that, when it starts getting close, I do put in GTCs to get out. And you're more likely, and that's a great point, Aaron, is if you do that, especially as a newer trader or even as an older trader, you know, maybe older traders have more tendency to get lazy and try and squeeze things out when we think we know more than anything else, or whatever. But that is something where you're not likely to say, I'm going to squeeze it out and start adjusting that. So that's a good point. You can definitely do it as a GTC. All right. David's asking, what is the advantage of the diagonal different months over the basic put debit put spread? The benefits of this, you have much longer duration to be right, and if we paid for our extrinsic value, you have the opportunity to have that naked long put on, if you will. So you have the unlimited profitability potential. But, you know, again, I'm not going to, I don't swing for home runs, you guys. I swing for singles, doubles, and triples. Every once in a while I will, but that's a very rare occasion, you know. At the end of the day, I like to, to grind it out and get those profits and take them off the table and take them off the table. You know, I mean, even in Vegas, what I do is I set up with like a certain amount of money, and if I'm going there, and I usually only go there and play like blackjack because I like the atmosphere of hanging out with my friends. You won't usually see me going up to a table unless I've got 5 buddies at that table. But one thing I do is I start off with a stack, and if I burn through that stack, I'm done. And if I make more than what I have on that stack, that extra goes in my pocket. And then when I burn through that stack, I'm done. So that's how I play blackjack. You know, one thing to know is, you know, I teach probabilities, and I teach turning the probabilities in your favor to increase your success rate, right? Because that's the way to really get ahead in this. If you're playing low probability strategies and swinging for home runs, you're going to strike out a lot. And one thing I always compare this to with like Vegas is when you're playing with the probabilities in your favor, you're like the house. You're like the casino. And everybody else on the floor is swinging for home runs. And the casino knows that if you beat them in probabilities, what are they going to do? They're going to come down there and they're going to offer you a steak dinner. They're going to offer you a free night stay. They're going to try and keep you there longer because they know that time is on their side and probabilities will turn into their favor again because probabilities are the probabilities and they're likely to win their money back. So keep that in mind. Play the probabilities, make sure they're in your favor. Did I answer your question on that, David, about the benefits of this? How many days on the long side? It's basically, Teresa's asking, picking 35 days to expiration on the short side, how many days for the long side? It's basically going to be about 35 more days. It's the next option cycle, which is, you know, that, you know, it's going to be closer to 70 days-ish. All right, so our break even is going to be that long put strike minus the debit paid. Remember, we talked about that scenario where the intrinsic and extrinsic value of this is. What we want to actually try and do, if you're paying for all of the extrinsic value here, and whatever that debit paid is the extrinsic value. If you actually pay more than what the extrinsic value is and you start paying into the intrinsic value, that increases your break even to above where the underlying is actually trading. Now, you can't always do that, but sometimes you can. And if your break even is above where the underlying is trading, you're already setting yourself up for success and increasing your probabilities of success, right? Because you're already in a winning trade. It doesn't always work out that way, but there are occasions that it does. And a lot of times it's easier to get your break even above where the underlying is trading with the put diagonal as it is opposed to the call diagonal, because there's skew to the puts. Now, people have a tendency to pump up the puts. There's almost always skew to the puts. So it's a little bit easier with the puts than it is with that call diagonal, but you can still do it in both. Aaron's asking, can you sell the weeklies against the long monthly? Absolutely you can. As a matter of fact, you know, if you want to do that, and it's a little bit more advanced, but absolutely, I would set it up as the first one month to month, right? But then if that first one expires worthless, then I would definitely, you know, you can definitely go into the weeklies. Just make sure that there's tight bid asks in there. You know, sometimes they have weeklies in the option montage, but the monthlies have really good markets and it meets that rule. That rule that I was talking about, 10 cents wide on the stock under $100, still applies to the weeklies. So make sure that the weeklies still have those tight bid asks. And the reason why I do that, you guys, is because if you have to give up so much of an edge to get in and, you know, again, that edge to get out, that eats up your margin, or that eats up your yield, I should say, over the course of your life. That's a lot of money going back and forth. And, you know, if you have to give up 25 cents to get in, 25 cents to get out, you know, that's 50 cents that you've had to get up. And you've really increased your risk by getting yourself involved in that, because you've taken on this time that you've invested in this trade, been directionally right, but now you got to give up all this edge to get out. I mean, that's a lot of risk. So don't play around with those stocks that don't have a lot of option trading going on. When you exit, do you exit both together or exit one side at a time? I usually will exit this strategy at the same time, unless, you know, the market, let's just say the market has completely flatlined on me the entire time I've been in this strategy. Theta decays worked, you know, in my favor. Market's trading sideways. I'm really not losing money. Let that option decay, and as long as my directional assumption is still to the downside or is still bearish in this underlying, then I might let that front month expire. If it's traded completely sideways or just slightly down, let's say it just got, you know, my short put expires worthless. This one's gone in my correct direction, and I can move further out in time and further down in the option chain and collect a nice credit, then I'll probably do that too, and roll it out. And that's what I was kind of talking to, I think it was Aaron or David about, was rolling that out through the weeklies. So yeah, you can definitely do that as well. All right. How much debit would you pay for the diagonal? Percent of the spread, yes. It's 75% the width of the spread. Less than 75% the width of the spread. All right, so the break even, we got that. Everybody has got this. Volatility can affect the break even just like it can affect your max profit, all right? Your break even can go up or down depending on where volatility goes, but ballpark figure is, you know, the long put strike minus the debit paid. All right, so let me get up the option. I usually tell you guys to start throwing out some stocks that we can look at. Let me go through a couple of good examples because we're running tight on time here. So I'll throw out a couple of examples. You guys can shoot them out there, and because I like the give and take. I like to look at the stocks that you guys are looking at in order to go through the steps. So Will, like CMG, hey, I'll fade CMG. All right, we'll do Will's real quick. All right, so $300 stock. Rule is go through 3 ticks to the left. That's 30 cents. We call it 31 cents. You know, CMG does have it. They're actually these have gotten really wide. $2. So that's in the further expiration. But we want to look at the nearer for the clean month. Look at these nearer ones, and it's like these options strategy, or these options have gotten really wide since I haven't traded them in a while. They used to have pretty good markets. It's got a high implied volatility percent above 54, probably because of all the news that they've had out, so that could affect it also. But that's one of those situations that I'm probably going to kick CMG to the curb, because that's just way too wide of a market for me to play with, because I do not want it. That's that situation where I got to give up $1 on one side and $1 on the other side. I mean, that's a lot of risk, right? All right, so I'm going to skip that one, and that's probably the reason why I haven't been trading CMG in a while, but I'm going to stay away from it. I don't want to give up that risk. I don't want to give up that edge. I want something tighter. All right, let's look at Apple. So Apple's $150, $160 stock, 3 ticks left, 16 cents wide, and you know, they're 10 cents wide. Usually they're even tighter than that, the 16 cents wide here and there. All right, so that meets the rule. You know, and one thing I understand that CMG may even have tighter markets during the week. It is a Friday. Nobody's going to leave orders in on a Friday and wake up on Monday and have those things executed and things of that nature. So people pull their orders, big orders, especially on Fridays, and we'll leave them in there during the week. So, oh, I thought somebody picked one of mine. So this fits that rule. You know, I have a position in my margin account and in my IRA on Apple, so I'm not trying to do this to get you guys living off the cliff with me. I'm just full disclosure, and I throw it in this account for daily market commentaries and stuff. Anyway, so one of the first things I do is kind of, if you guys are technical traders, you can look at this and say, okay, well, if you're a technical trader saying, all right, I think Apple's going to come down to around 144 or something like that, or you have your target where you think, okay, it's going to cover this gap, stuff like that. So that's a starting point on where you set up this strategy. Now, one of the things that I said at the beginning of this was, you're buying the further expiration to sell the front month. Well, I always set this up backwards. And the reason why is because I want to know how much extrinsic value I need to pay for in that particular underlying. So what did we say, 150? We think it's going to come down to 150 or 145. So we'll start looking at those strikes. So 150, 86, 145. 145s are not going to get that much, but 150s, we could look at selling these. So little floor trader hack here for you, 65 cents. So that is what we have in order to pay for our extrinsic value. We only have 65 cents of extrinsic value we can pay for. So when we're looking at the option montage, which this is the option montage, all these strikes, we look over here, well, how do we determine? We can go through and go, okay, 160, we can figure that out with the math and all of that stuff, but a floor trader hack is extrinsic value of an in-the-money option can be found by looking at the corresponding calls. It's not always exact, you guys. It can be off by a nickel, but I'll tell you what, I'm not worried about the nickel. I'm worried about burning brain cells trying to figure out the intrinsic, extrinsic value of all these when I can just go, okay, it's 50 cents. So if I can sell, if I have 65 cents and it's only 50 cents of extrinsic value, then I'm going to look at doing that. All right, so this is looking like a good one already. So what's the next thing, next step we said to do? Oh, one thing I skipped was, let me do this real quick. You want to make sure that the difference between the 2 months is within 2 percentage points. Remember when I said that? So let me just close this one out. The difference between the 2 months is less than 2 percentage points. This is where I'm talking about. This is where you look. 2 to 3 percentage points, 3 on the high end. We also want to have, and this fits that rule. See, it's 23.20, 24.99, so 25. So that fits that rule. There's not going to be an option. There's not going to be an earnings event in this month here, but you could do it if you thought volatility would expand, which I don't expect it to. And the other thing would be, what's the IV percent? It's above 72. So in that, looking at this, we can see all those other rules fit. Even this is going to be 75% the width of, inside is 75% the width of the strikes, because we're paying $1 or $11.22. It's $20 wide. So to figure out that if it works, it's 56% width. So that seems great. But the problem is volatility is really going to affect these premiums. So we want to stay away from that if volatility contracts rather quickly on those. So be careful with that. You could do it, but just be careful. All right, so what was somebody, don't spreads get a little wider Friday afternoon when the cash market closes? Yes, it does. That's one of the other thing I was saying with, especially the bigger stocks. What criteria do you use when you select those stocks for the diagonal? Do you look for in the chart? What do I look for in the chart? I usually, if I'm going to do this, I look at support and resistances also, and especially market profile. Like this to me is, as you can see, this is going to act as a support also. So right here where this volume node is. it's going to act as support. It correlates to that. So that's why I was kind of like, you know, you pick any one of those, 50, 45, depends on what you want there, right? But I'm going to skip that because it doesn't have that binary event. So here's one, Netflix. Let's look at it. So let me delete that, let's close that. It's got low implied volatility. It's below an IV percent of 50, which fits. It actually has earnings coming up in this month, I believe. I'm pretty sure. I double check that. Let me just make sure. And I'll X. So Netflix has that earnings event, right? It's right there. That's the month we're buying that put in. So that fits that rule. It's a $165 stock. So 16 cents wide, that fits that rule. 16 cents wide, we're inside of 16 cents for these months here. Okay, 29 IV here doesn't fit the rule here because as you can see, that's 38. So it's almost 10 percentage points wide. And this is why it's really important, you guys, to make sure that the ones that you're doing have that spread inside of $2, because if I go and look at this where I'm going to be buying an in the money put, so let's just look at buying and I know that this stock is going to be very margin intensive, but let's do it for sake of course the premiums changed since I betted this one, and then selling the 160s to try and pay for that extrinsic value. Close to it, right? $2.19 or $2.15, $2.05. So we're 10 cents off on a big dollar stock. But earlier today, this has come in by $5. This was $28.22. The premium was $28.22 when I was looking at setting this strategy up for you guys for this webinar. I was looking at different things, and when you see these major differentials here, but it obviously came in quite a bit. But that's what you'll see happen, where $28.22 on a $30 wide strategy, you can see where that's just absolutely ridiculous. I didn't quite get to 100% of my width of my strikes, but I was very close. I was $1.80 off. But you'll see that happen. That's why it's really important to follow all of those rules, because you're setting yourself up for disaster. In this case, $23.63 divided by $30 wide is still 78. So that doesn't fit that rule. It's over 75% the width of the strike. And when I was looking at it, I wrote it down. It was $28.22 at one point today, divided by 30. 94%. You're paying 94% the width of the strikes. It just does not make sense. So make sure you follow these rules, okay? All right. No, you don't short. I don't want to confuse anybody. You don't short those puts and those those calls. I'm just showing you. If I'm looking at the 190 puts, you can look over here and see what the extrinsic value, the corresponding calls, gives you a hint as to what the extrinsic value of these options are. Okay. It's just it's a floor trader shortcut that we would use. It's really close. It may be a nickel off or something like that, but if it saves you, 15 minutes going through figuring out exactly what all the extrinsic value of this is, and you can just, blindly look at this rather quickly, and I can save you all that time, and you can easily move on to the next strategy without having to think too much, then do that, because, that's what I do all day long. Is look at those. Okay, so another one. Let's look at like eBay. I think is a good one. I think eBay was working out. Hopefully nothing's changed in eBay since I did it. So We can look at the charts and look at eBay. We can think maybe, let's say maybe eBay is going to come down to this point of control or even this point of control. This is time and volume. So anytime you see these high nodes, that's where the market wants to migrate to, because that's where value has been accepted. Let's go right in between them. So yeah, because I don't want to go to the 32s. That's just not getting very much money at all for those. Bid ask 10 cents needs to be 10 cents wide. They're only 2 cents wide, so that fits that rule. Implied volatility percent 22%. It does have earnings in this cycle, in here, and so we would expect, as you can see, eBay does a really good job of losing volatility all the way up until that month of the earnings event, and you can see it just ratchets up all the way into it, and that's exactly what we want in this situation, is that front month to decay, worthless, and then implied volatility to expand, because we can be still market neutral. The market's not even gone anywhere. It's traded sideways, and it could even be going the wrong direction where the market's going up. But if implied volatility starts spiking like this heading into that binary event, we can be directionally wrong and still be right, because if the premium inflates more than our directional assumption being wrong, then we're going to actually be benefited by that expansion in those premiums. So that's just another way to increase your probabilities of success, where you can be directionally wrong and still possibly have the opportunity to be right. Okay, so that's why it's really important to follow these rules again. Again, we're looking at the September difference between those. That's a little bit wide. It's closer to 4 actually. So let's move on to the next one, just for that reason. I want to stick to those rules. I was pretty sure that that was inside of 3. Okay, so Wells Fargo is close to 3. So we'll do that for lack of all my betting. Let's look at Honeywell. One last try. Hopefully Honeywell didn't scream outside of my... it does have, H-O-N. Honeywell has a binary event coming up in the October. The bid ask on these is 14 cents wide. Is it 14 cents wide? Yes, it fits that rule. 14 cents wide, we're working. Because it's, remember, it's 130, for all intents and purposes, 100. So 13.5 cents, so 14 cents, right? What's a half a cent amongst friends? All right, so I'm going to look at this for, we could go in here to the option montage and say, okay, where do I think it's going to go? Down here to 130, so let's look at 130s. So 130, 135s. So I'm going to look at the 130s. So those are, I'm going to sell, so I'm thinking I get about 30 cents for those. Even though it's going to default to that, it'll fix it. So that means I need to buy the ones that are close to that collection, which is the extrinsic value. Buy that one, right? So we're paying $13 for a $20 wide. So most of you guys doing the math in your head right now know that that's going to fit the rule here. So so let's just call it $13 divided by 20, right? Just to speed it all up real fast, 65. Even that nickel's not going to throw it out of line. So 65%, that's even better, right? That increases our reward, and in that would increase our ability to achieve 50% of max profit faster. So another thing we need to look at also is what's our break even? Well, it's at $15, or sorry, $150 minus the $13. That puts us at 147 or 146.95, right? If I do it exactly, 146.95, and see bid ask here, that puts us above where the break even is, even where the offer is. So that's one of those situations where I was talking about. Now our break even, we have like a dime directional assumption being wrong to be right. So that break even above us means that we paid for all the extrinsic value also. All right, so that fits those rules in and around that. Has a binary event. It's, you know, less than 2 percentage points wide. It has a tight bid ask. It's less than 75% the width of the spread. Fits that. All right. And then the next thing we need to figure out is what is our exit. So if we're at $13, it's $20 wide. Our max profit that we can make is $7, right? Because when it's worth $20, then that's when we've achieved 13 plus our 7. So $7 is our max profit. So 50% of that, because remember our exit strategy is 50% of that max profit, $3.50, right? So that's when we get out, when we've made $3.50 on this strategy. So how do we know when to get out? You add in what you paid for it, plus the $13. So we're exiting when this is worth $16.50. It's that easy. And write that down. Like right now, right before I send this thing off, that's what I'm writing down. $16.50, I'm out. Okay? Stick with the strategy. And you'll be able to get that even if it goes down and these 130s go into the money and stuff like that. That you're going to be able to get that 50% of that max profit. Unless it happens like overnight and volatility explodes and stuff like that. But that's a different situation. We don't want that to happen. We want it to just kind of start slowly trickling down there. Okay? What does it mean when the debit keeps changing up and down? It just means like the markets are changing. Somebody might be bettering one or the other, and it'll keep flexing. You can hit the lock button to lock it down, but it just means that these markets are changing, and why they are, I don't know. Somebody probably playing around in the thing and just putting bids and offers in there, knowing they can't get filled. Chris, is this being recorded? I joined late and have been interrupted several times due to still working. Thank you, Chris, for participating in this while you're working. Yes, this is being recorded, and one thing I say is watch it again. Chris, you might want to watch it twice just to make sure that you get this all down. And we will be sending this out in an email. It takes me about an hour or so to compress this video and send it to home base and get that sent out in the emailer. But watch it again, and if you haven't gotten all of it, watch it again. Okay. So own my own business, so the boss won't be too mad. Okay, great. So do you sell or buy the strikes where you think the stock will go? You sell the strike where you think the stock is going to go, because that is where we want it to go, right? We don't want to be buying this in the money put and have this stock go higher towards our in the money put. So I look at selling first and then look to where I need to buy it. Where I think it's going to go, I sell it. Okay, I'm going to get that much credit. Now I need to buy the one where I can pay off that credit. Can I repeat the 2% rule? Absolutely. This is the 2% rule. When you're looking at the option montage, selling the near-term expiration and the further term expiration, we need this number over here, the volatility associated to that particular month's expiry, to be less than 2 percentage points. So 1603 to 1756 is 153. Well, now it's 154. It changed on me, right? But 154. So it's a 1.54% difference. Whereas when we were looking at, I think it was Netflix, when we're looking at Netflix and we look at the difference between those 2 months, this one being here 29 to 38. So that's almost 10 percentage points. So we do not want to do it in that situation. if this was 38 and this was 27, that's that one where I was talking about, like that's the diamond in the rough, because you're getting paid a lot, or you're getting paid to sell these premiums, and you're paying a lot less for these premiums. So that allows you to make that spread really wide. It's really good. Do I have a stop loss on this trade? Now it depends. You know, if I was doing something like Netflix or something like that, and I'm paying, you know, a lot of money for it, I might get out at about a 50% loss. But usually when I'm paying a debit for a strategy, that is my stop loss in that sense, and I'll probably ride that out. Anytime I have defined risk, I know what my risk is going into it, I'm going to kind of ride that one out. Okay, but I have maybe a higher risk tolerance than some of you other guys, so you could look at it like, all right, well, I'll get out at 50% of what I paid. So when this is trading at $6.50, I'm going to pull the ripcord on it, and I have no problem with that. Okay. All right, so, you know, and you're playing the probabilities. That's the ultimate thing here, you guys. So trying to get those probabilities in your favor. I mean, you know, I like to look at the charts too, right? But technical analysis and just knowing how to do a put diagonal, like reading about technical analysis and reading about how to do a put diagonal, you guys, isn't enough to turn the probabilities in your favor. Doing these other little nuanced things that I'm talking about, knowing that volatility is going to expand in that put that we're long, is key to increasing the probabilities of success. And that's what I try and teach you guys in all of my webinars, is how to increase these probabilities to turn in your favor. And this course here, how to trade options like the Wolfman, is great for that. So if you guys learned anything at all, I mean, even if you've learned that little subtle trick on how to figure out what the extrinsic value is, you could be a savvy trader and never have known that little quick trick. Then for 36 bucks, you guys, this is a great deal for, you know, all of these options course. I mean, this is over 15 hours of options webinars and things of that nature on how to use delta to measure your odds of winning, you know, probabilities. That's what I try and emphasize, is trading probabilities. How to use options trading gamma. Gamma trading is actually a lot of fun. History of options, this is really a cool one. Thales from Miletus is the first person that ever traded options, and Aristotle actually wrote about him. And how to protect your portfolio in rising interest rates is hugely important for most of us that have, if you have any bonds in your portfolio, this is huge. So, I mean, wouldn't you guys basically say that you'd be better off if you had higher probabilities of success, right? I mean, that seems like a no-brainer. If you're the house, the casino, and you guys really need to be trading with this knowledge. And if you enjoyed my instruction, or when you're my regulars, you guys should learn this for only $36. The normal price is what, $970 or $997. So I mean, that's a crazy good deal. And you know, I'm always trying to become a better trader and find the best ways to trade and create consistent winners, trying to learn, which you guys are clearly trying to do, and you guys made that decision to already become better traders by trying to learn and by attending this webinar. But wouldn't you say that just knowing how to build, after watching this webinar, knowing how to build a put diagonal just isn't going to be enough to create consistent winners or create high probability trades? I mean, basically what I mean is, even if you're trading technical analysis and building straight strategies by reading them online, isn't going to be enough. And the best way to get ahead in this game, you guys, is to trade with high probabilities. Because if you're trading with high probabilities, you can be wrong and be mechanical and still make the probabilities turn in your favor. Because if you do it more and more, those probabilities will work themselves out. So anyone can teach you guys how to build this strategy. I'm not going to lie to you. You can find out how to do it, but no one else is going to teach you guys how to trade the way that I do, where the probabilities are in your favor. And that's how I teach. How to play the probabilities, when the probabilities have gone against us, how to stay mechanical, and how to increase our probabilities even further, creating more and more alpha, you guys. So we're offering this trial today. So what do you guys say? Go ahead and click on the link. I'll throw it in the chat box. We've been going through the webinar on the in the questions box. It should be in the chat window right now. I did that myself. I figured it out finally in that chat window. So what do you say? Go ahead and click on that. Get started today. One thing is, having the right tools for the right situation, you're going to be in a more productive state of mind. It's going to allow you to put on more strategies, which creates more opportunities, and ultimately building confidence, which just cycles back around. You're going to have the right tool, or you're going to know what the right tool is for the right environment. You're going to create more strategies, create more probabilities, create more success. I mean, it's just going to cyclical, keep going and going. And if this strategy doesn't work for you the first time, just have solace in knowing that, hey, the probabilities beat me on this one. The next time, I know the probabilities are in my favor, and that will also create more confidence. So take advantage of it. If you learned anything from me at all, like I said, trading with this knowledge is invaluable, and you guys really should take advantage of it straight away. And I see a bunch of people throwing some questions out, so I'll get to that real quick. But let me throw out this for some people that got to go before we get into that. I just want to thank you guys all for joining me. Future webinars, I'm going to be going over when and where I find them appropriate. This is also the link for that same thing, how to trade options, like the webinar Wolfman. So you can pause this, just write this down, type it into your URL if you want it, if you're receiving this email in the email. And thank you guys or if you are even not able to get in, because I know we are full again today. Thank you guys for watching. If you want to contact us at 310-598-6677, or you can email us at trading@protraderstrategies.com. And let me know if you guys have an option strategy out there that you want me to cover and you haven't seen me cover it. Give us a shout out. All right? If you can't take that, take it easy. Oh, and this is also the link here. So the link should be in that chat box, you guys. Have a great weekend, Graham. Take care. To be clear, do you subtract the front and the back month volatility to come up with the 2%? Yes. I mean, if you subtract the front month from the back month, it kind of gives you a negative in a sense. You just don't want that to be any more than, usually the back month is going to be higher, Trevor. So you just want the difference between those two to be inside of 2%. If the back month is lower than the front month, that means you're getting paid. When you're selling that put, you're getting paid more for volatility than what you're paying for volatility in the back, which allows you to make that spread get wider. Thanks, Chris. Appreciate the kind words. Take care. Okay, Ted, I joined the webinar late, but can you comment or explain on the rebalancing of the VXX? How often is the rebalance? What factors do you use to multiply the old strike price by? Thanks. Especially if you have covered this already. Okay, I don't know if I know exactly what you're, thanks, Ted, I appreciate the kind word. So the front month could be higher. So Trevor's asking, so the front month could be higher. Yes. So the front month volatility in some instances will be higher here than here. And in that case, that's a great opportunity for this strategy. Now, it's not always the case. But Ted, trying to wrap my brain around your question here. How often, explain the rebalancing of the VXX. Are you talking about the volatility here, Ted? They didn't really, I don't think I talked about the rebalancing of the VIX or the VXX. But I want to make sure I get your question right. Thanks, Trevor Wolf. The rebalancing, I mean, were you talking about what I was talking here with the volatility percent being less than 2% between these two? So for instance, in Honeywell, you know, it's right here, the implied volatility for October is 17.5, and the volatility for September being 16.2, that being inside of 11. Oh, the symbol VXX or VIX, yeah. If one had an order for the 11s. So this isn't really in regards to what I was talking about, but you're just talking about the VIX in general. Like what, oh, are you maybe putting this on, when, like a put diagonal on in and around this? Well, oh, the VIX. So the VIX, this VIX doesn't really tell you exactly what, it isn't a direct correlation with what these volatilities are showing. What these volatilities are showing over here, and this being in the 40s here, is just the volatility in and around Netflix. So each stock has its own implied volatility, okay? And Netflix has a tendency to get really high volatility in and around its earnings event. And there's an earnings event right here. And everybody knows, you know, Netflix will have like a 20%, $20 market maker move priced into it. And so they're pricing that in already. So the VIX really just tells you what the broader market's volatility is, but each individual underlying will have its own implied volatility, you know, especially like the ones that have earnings coming up, you know, right here. If you look on the side here, this is the implied volatility percent. This, each of these isn't going to be affected necessarily by the VIX. It will actually affect them a little bit, of course, but you know, these will stay high when the volatility in the broader markets crashes, and that's when these are really going to kind of get affected. Does that make sense? Great. All right, everybody have a great weekend. Take care, guys. Thank you, Amy. Appreciate it.